Good morning, Bowtie Nation. Joseph Hogue here with you. Thank you for joining us for another one of these Monday market updates coming to you 9 a.m. every Monday morning. Get you ready for the week with the stocks I'm watching, the economic news to watch. Great video for you this week. A couple of weeks ago after the CPI data came in lower than expected, market jumped off of that, but we really don't have much for economic news. No inflation data until the first. Not much for earnings coming out over the next couple of weeks. So investors are looking for a way to invest in stocks and a strategy that's going to work. Article out of Wall Street Journal last week really got my attention for this. Actually, a strategy that's beating Warren Buffett, by 11.9% annualized over the last 5 years, beating by hundreds of percent over the longer term. Want to share that with you this week. Want to share with you the stocks I'm watching as well as the economic news. First, though, did want to highlight an amazing offer there on the Webull platform, with investors kind of losing a little bit of that enthusiasm they've had over the couple of years. A lot of these investing platforms, these brokerages, are offering amazing deals to sign up and to start using their platform. So you've got Webull here offering up to 12 free stocks. Usually it's closer to about 4 or 5 free stocks. You get 2 free stocks just for opening an account there, and then you get an additional 4 to 10 shares up to $3,000 each when you deposit any amount. And that's something else too. Usually it's you have to deposit $100 or more. They've lowered that to deposit any amount. Deposit 1 penny and you get those extra 4 to 10 free shares worth up to $3,000. I'm going to leave a link for that in the description below. Click through, check through that. They've got an FAQ section here, frequently asked questions. You can see, answer your questions there. But again, check that out and use that. I use the platform. I use it for the stock simulator. Kind of test out my ideas for free before I invest any real money. But it's a great platform. Check that out. You'll be helping to support the channel, so I appreciate that. And you're going to get up to 12 free stocks. I do want to get to this week's topic, though, in our Monday market update. I normally cover some kind of market-moving theme or trend in these weekly topics, but an article there in the Wall Street Journal last week really blew my mind and opened up an investing strategy that I think everybody wants to hear about, right? This story revolved around Barry Diller's company, IAC Interactive, and its kind of catch-and-release strategy of buying assets, developing them, and then spinning them off into their own companies, right? Along with the rest of the internet and growth stocks, shares of IAC are down hard this year, down about 71%. But it's since February, but it's hard to argue with the returns this company has been able to produce from that spin-off strategy. Okay, you see here just back 5 years, 2017, it was as low as $27 a share. It jumped to as high as 165 there in the pandemic frenzy. But it's always produced a really good return on that catch and release program. So I want to talk about that. I want to talk about how to invest in spinoffs, why the data behind the returns on that, and how those are actually beating Warren Buffett's stock portfolio by 12% a year. So the strategy does involve spinoffs, and Barry Diller's strategy is a little bit different. He actually goes in and buys the struggling companies, buys new internet companies, develops them under IAC Interactive, under that conglomerate company, and then spins them off into their own company to really reap the profits from that development. And the crazy part here is IAC was actually a spin-off itself, and this is crazy. This is hilarious. It was originally a subsidiary of the Home Shopping Network back in the 80s. Okay, so a $4 billion internet company. It's been valued as high as 10 or 15 billion dollars. Over in the past, was actually a subsidiary of the Home Shopping Network back in the 80s. I was spun off into IAC in 1993. At its peak last year, the company's shares have surged 840-fold in those 28 years, right? So since 1993 to the peak last year, 840 times, the share price, just because of that return. That's an annualized return of almost 50% over that period. Just some of the spinoffs of the company has spun off since 2008. Just the 5 spinoffs they've done since 2008. Ticketmaster, Tree.com, which is now LendingTree. Shares of IAC have produced a spinoff company shares of 29% annualized through 2021. So 29% annualized return through 2021, up 47% a year over the last 5. That's easily beats the S&P 500, as well as Warren Buffett's Berkshire Hathaway, right? S&P 500 over the past 5 years is up 18.5%. Warren Buffett up 13% over that 5-year period. And we have IAC Interactive up over 47% a year over that period. But it wasn't really these amazing returns for IAC that caught my eye in this Wall Street Journal article. It was another study that in the article that uncovered this investing strategy in spinoff that you need to know about. So a 22-year study beginning in year 2000. So year 2000 to 2022, the Edge Consulting Group did this study and found that spinoffs as an asset class, so just investing in the spinoffs when they were spun off from their parent company, generated a 3 to 4 times return compared to the market in the first 12 months. So if you invest in a spinoff, the day the spinoff is actuated in the market in the first 12 months, 3 to 4 times what the market does over that period. Given the S&P 500's return of about 7.5% over that 22-year period. Okay, so the general stock market did about 7.5% a year in those 22 years from 2000. I would put this strategy of investing in spinoffs in that first year as a separate company at 22.5%. Okay, 22.5%. That's well beats that 3 to 4 times the S&P 500. It beats Berkshire Hathaway's return over the past 22 years of 10.6%. So beating Warren Buffett by 11.9% over the past 22 years. And investing in spinoffs, it's several other studies really back up this data, right, of investing in spinoffs, and even parent companies can outperform on those levels, right? A 1993 study by Kusatix and Miles in the Journal of Financial Economics found spinoffs and the companies and the parent companies beat the S&P 500 index by an average of 30% and 18% a year during the first 3 years after the spinoff. Okay, so the spun-off companies, the companies that are spun off into separate shares by the parent company, separate shares into the market, those beat the market by about 30%. And the parent company itself actually also beats the S&P 500 by about 18% over that first 3 years. Another study from 2000 to 2005 by Chip Dixon found the spinoffs beat the market by an average of 45% during the first 2 years. So a lot of this data coming from those first few years after the spinoff. I'm going to explain why that is, why spinoffs tend to do so well over the first 3 to even up to 5 years, but really first 3 years after they're spun off. And I want to back up a little bit just to kind of explain spinoffs, and then we'll look at why they tend to beat the market and how to invest in these. A good example is going to be AT&T, right? AT&T, telecom carrier, which a few years ago, just as a few years ago, owned satellite TV provider DirecTV. It owned media company Time Warner. So this is a telecom carrier that had just been gobbling up other companies, had just been buying up other companies to become a conglomerate, really a media conglomerate over those years. And we all know what a train wreck AT&T shares have been over the past 5 or 10 years, right? Since they started acquiring these other companies, the stock price has gone nowhere but down, right? The company just couldn't manage all those segments. Now that most recently though, it spun off shares of Warner Brothers. It's Time Warner to it's Warner Media business to Warner Brothers Discovery. So it spun off a lot of these. It spun off DirecTV. It spun off the Warner Brothers, and the shares have actually been doing very well this year. We're going to see the same thing happen to General Electric, right? Last year, November 2021, General Electric announced its plans to split the business into 3 independent companies. So this isn't necessarily a spin-off like we see a lot of times. This is just a complete breakup of the company. The company GE, General Electric, is going to break up between 3 companies: GE Healthcare, GE Aviation, which is going to be named GE Aerospace, and then a combined operations of GE Digital, Renewable Energy, and GE Power. That's going to be named GE Vernova. Okay, so General Electric, 100-plus-year-old company, is going to break up into 3 separate companies there. And there are intuitive reasons why this happens and why it's actually good for the companies, why those stock prices take off in those first few years. One is the conglomerate discount. Okay, there is actually a conglomerate, a discount valuation on conglomerate stocks, right? Stocks like GE, stocks like 3M, those companies that own many, many different types of businesses within that one company, they trade at a discount valuation compared to more focused companies because really the belief that they aren't getting all they can out of each segment. Okay, so GE has GE Healthcare, GE Digital, GE, Aviation. It's got all these different types of business, and the idea on Wall Street and among investors is they're really not able to get everything they can out of each one because it's just so much to manage, right? So once these parts are broken off, so in GE's case, once the company is broken up into individual companies, in AT&T's case, once it breaks off DirecTV, once it breaks off the Warner Brothers into the spinoff, things like that, then it's just much more easy to it's much easier to manage, right? Right, management usually also has a very much better incentives in the spinoff companies. So a lot of times, what'll happen is they'll spin off a part of the company into a new company. Some management will go with that and become the executives, become the CEO and the CFO and the COO of those companies. And they'll have those incentives, share-based incentives, as well as stock options that will incentivize them to really grow that company quite a bit harder, right, in that newly spun off company. They also don't have to get the go-ahead from that bureaucratic system, right? If GE Healthcare, wants to do a project that could grow the business, they have to go through the higher level of GE management, right? They have to go through not only GE Healthcare management, but also the management up above in General Electric. So it's a very long process. A lot of projects get shot down that could have amounted to a lot of growth for that smaller company. So once it's spun off, then the managers have a lot more freedom to go after those growth projects. So a lot of reasons why this actually happens, why those stock returns are so good in spun off companies, 1 to 3 years after the spinoffs occur. But one of the reasons why I like this strategy is because it is fairly simple to do, right? We're just looking for companies that have announced spinoffs and where investors are going to get shares of that newly formed company, right? Of the spun off company. You would want to go in and buy the parent company's shares before the spinoff occurs, right? So for example, you would go in and buy General Electric shares before that spinoff, and then when it occurs, you would have the shares of the parent company, General Electric, plus you would have shares of those spun off companies. Of course, in the case of General Electric, you would have shares of 3 totally separate companies. For the most part, when you buy a spinoff, you would buy the parent company, then it's going to spin off that segment, that newly formed company, and you would have shares of that. So you would have shares of both companies. It's your decision whether you want to stick with shares of the parent company as well. This strategy is really just focusing on the spun off companies and the returns on those, the returns that do generally beat the market. But we also see that shares of the parent company usually do quite well as well, just because it's now a smaller, easier to manage company. You don't get quite the conglomerate discount on the shares that you do on other conglomerates or as before. So shares of the parent company typically do very well also, but it's your decision whether you want to go ahead and stick around with that parent company or just take those shares of the spinoff company and let those run. I would do some further analysis in this for each spinoff, though. Research by McKinsey as well as PwC has shown that the most successful spinoffs are the ones that have a good explanation of how that new company is going to grow, right? They can't just spin it off just for the sake of spinning it off. They have to be able to say that, yes, we think that alone, separately, this new company, this new segment can grow on its own, and this is how it's going to do it, right? They have to have an explanation and a plan for that. They also have to have the plan, and the transition has to be communicated to employees to keep retention, right? What we see so often with spinoffs is that a company will announce its spinoff to employees. Employees get a little bit worried, right? And you would. If you were told that your company is going to break apart your part of the business into a new company, you don't know if you want to work for this new company. You don't know if it's going to grow or not. You don't know what that's going to be like. So the parent company really has to explain that transition as well as the plan to its employees to keep them around to form that newly formed company. Click on the video to the right for how to invest in a recession, how investing in a bear market is different, and how to do it right. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.